Hey, if you've been bullish on the market these last few weeks and been buying stocks, then you know how that's been turning out. Everything's been going down. Everyone's been losing money. So in this video today, I'm going to show you an options trading strategy that can, if you still want to be bullish, that can cut your costs by 50 to 60% upfront. At the same time, you'll have 50 to 60% less downside risk, and it'll at least double your returns by using this option trading strategy if the stock goes back up. So this is, I'm making a redo, an update to probably, I think this is one of my best viewed videos of all time, this specific strategy. So if you want to learn how to do this, hang around with me and we're going to jump right in. All right, everyone, Lee Lowell here from smartoptionseller.com. What we're going to be talking about today is buying deep in the money call options right here, the Smart Option Seller Guide to buying deep in the money call options. What are deep in the money call options? Deep in the money call options are call options that you can buy whose strike price is set well below the current price of the stock. So it has a lot of intrinsic value already built into it. I'm going to show you how to do this. I'm going to show you how to pick the specific strike price, and I'll show you with the numbers how you can cut your costs by at least 50% and have returns at least double than what you would pay versus buying shares of stock. Okay. So if you know nothing about call options and know nothing about deep in the money call options, I'll explain everything as we go on. We're going to look at an example, show you all the numbers, we're going to look at the option chain, and this is going to be a great way to use another type of strategy in lieu of buying shares of stock, okay? So let's just go through the list here, and then we're going to jump into the option chain, and I'll show you what you need to know. Number one, if you're going to buy call options, that means you are bullish, okay? You do not want to use this strategy unless you are bullish on the stock, okay? So number one right here, pick a stock that you're bullish on. Now, I know everything's been coming down, so it's really hard to be bullish on things, but things have come down a long way. You know, I'm a long-term bull. I know the stock market goes up over time, so I've been stepping in along the way, you know, buying shares of stock as well, buying these deep in the money call options. Number one, what you want to understand is that any option contract, it consists of 100 shares of stock. So we're always going to compare this option trading strategy to buying 100 shares of stock, and you'll see which one works better. Okay, so number one, you pick a stock that you're bullish on. Number two, you're going to scan the option chains for 90 delta options and compare those costs along different expiration dates. So let's just cover these two things here in this step right here. Delta. What is delta, and why do we want to buy a 90 delta option? In the options world, each strike price has its own delta. Now, deltas range from 0 to 100. And what a delta tells you is that how much that option value or how much that option price is going to move in conjunction with the move in the stock, okay? When the stock moves, the option prices move as well. But the option prices move a certain distance in conjunction to what the stock does. Any option you buy doesn't move point for point with the stock. It moves a fraction of whatever the stock does. So if you're buying a 90 delta option, that means that option price is going to track the stock's price by 90%. So if the stock goes up $1, that 90 delta call option is going to go up about 90 cents per contract. Okay, and that's 90 actual dollars. So we're always comparing 100 shares of stock. If the stock goes up by $1 and you have 100 shares, you're going to make $100. If you buy one deep in the money call option with a 90 delta, that option value will go up 90 cents a contract, which is actually 90 actual dollars. So it's tracking the stock's movement by 90%. Now, if you buy a 10 delta option, that means your option value is only going to move about 10% of whatever the stock does. So if the stock goes up $1, your option value, your option contract is only going to go up about 10 cents a contract, which is 10 actual dollars. So the whole key of buying deep in the money call options is that you want to buy an option that actually moves when the stock moves, okay? People will always buy these way out of the money call options that have very small deltas because their prices are very cheap. So people are paying for these very cheap options, which are more like lottery plays. The stock's going to have to go up a really huge amount in order for you to make money on those what we call out of the money call options that have small deltas, okay? So we're going to look at the option chain. I'm going to show you where you find these 90 delta options. And number three here, These are options that you really want to hold for a long period of time. If you're going to go in on the stock, if you were going to go in on buying the stock, I would hope that you'd hold it for a long term, because over the long run, stocks go up, stock market goes up. So you want to hold for all that appreciation. Now, options have contracts that expire in the same day. Those are called zero data expiration options, zero DTE. You have 1 week options, 1 month options, you got 6 month options. Some options go out 3 years in time. So if you're going to hold on to these things, you want to look at options that have expiration dates that are at least almost a year out in time. And we're going to look at different expiration dates, and I'll show you how you do that. And very important, whenever you buy an option contract, you want to know what your break-even level is. You need to know where the stock has to move to in order for you at least to break even on your option purchase, okay? And I'll show you how to do that simple math as well. Now, once you've bought that deep in the money call option, which is going to act very much like a stock, you can sell shorter dated call options against that deep in the money call option. It's kind of like selling a covered call, but in this case, it's called the poor man's covered call. In your traditional covered call, you would buy 100 shares of stock and then you would sell another call option against it. Well, in this case, you're actually buying one call option, the deep in the money call option, and you're going to sell another call option against it. It's really a call spread, but it's called the poor man's covered call. All right. And what does that do? By selling that other call, it's chipping away at the debit that you paid for that deep in the money call option. Okay. And then here, we're down here at expiration. When your call option actually expires, there's a couple things that could happen. If the stock really tanked, it may expire worthless, but we're hoping that's not going to happen. So at expiration, you can either exercise that call option and turn it into actual shares of stock. Every call option can be turned into 100 shares of stock, and you will have to pay for those shares of stock at that time. Okay. Or you can roll it to a new further out expiration date, which means you would sell the current call option that you have and buy another deep in the money call option for another year out in time. Okay, you don't have to exercise it. You don't have to pay upfront money. You're just rolling the trade. And lastly, you can actually sell your call option back into the market for whatever it's trading for at that time, and that'll produce either a profit or loss. Okay, so those are the few things you can do once expiration rolls around. And lastly, there's risk management. Okay. There's no guarantees that this strategy will work. If you're bullish and the stock goes down, you're going to lose money. So you want to have some kind of risk management plan, which is setting a stop loss for yourself. Set a stop loss as you would if you had just bought the shares of stock. So how do you set a stop loss? Well, if you bought a stock at 100, how much are you willing to lose? And you can set that loss as a percentage loss or an actual dollar loss. Okay, so you have to decide up front, am I willing to let the stock drop 20% from my buying level, or am I only willing to risk, $500 or whatever it is you decide. Okay, so now that you know basically the background of buying deep in the money call options, let me show you why it's so much better than buying 100 shares of stock. So let's go to, let's pull up the charts here for a second, and we're going to, let me get my charts up here. Whoops, hang on. All right, let's pull up, let's use Apple, okay? This is a chart of Apple. Let's just assume that, you love the company, you're bullish on the company, so you want to get a stake in Apple. You don't have a stake yet. So you can either buy shares of stock or you can buy a deep in the money call option. And let's play both sides here and see what could happen. So here's a stock of Apple going up, and then just like everything else, since February, it's just been coming down. Hit a low of about $170, and now it's trading around just under $197 right here. Okay, this is where it closed on Thursday, April 17th, 2025. We'll assume right around $196, $197. It's come down from its high of $260, so it's fallen a pretty good way. So let's assume that you're bullish on Apple, and you can either buy 100 shares of stock or you can buy a deep in the money call option. Now, let's pull up the option chain and look at, let's look at call options for Apple. Okay, I got Apple pulled up here. So here's the option chain. It's got call options on the left, put options on the right. And this is what a typical option chain looks like if you've never seen what an option chain looks like. It gives you the values for every single option contract that is trading for a specific stock. And really the columns that I want you to concentrate on, number one, Their strike price is right here. Number two, the bid and ask prices. Every option, just like a stock, will have a bid and ask price. And also in your option chain, you want to have the delta column right here. Okay, so here's the delta. If you have an option chain with your broker, make sure the delta column is in there. You can do your settings. Delta should be available in any option chain. Okay, now we have, you can see all the expiration dates. April 25th, 2025 is the shortest expiration date for Apple, and the longest expiration date is December 17th, 2027. Okay, so it's almost, 2 3/4 years from now. So we want to concentrate on, let's look at an expiration date almost a year out in time. So let's look at March 20th, 2026. So it's 335 days from now, pretty close to a full year from now. And we'll compare it to the June, which is a little bit longer than a year. Okay. So number one, the first thing you need to do when you want to consider looking at a deep in the money call option. Now let me pull this over here. So here's the last price of Apple in the aftermarket, $197.25. And here's the bid and ask prices. You can look at the last column as well, but sometimes the last price traded could have been from a while ago. So that might not give you a good idea of where that option is currently priced. So that's why you always want to look at the bid and ask, because that's the up-to-date, up to the second value for that option contract. Okay, so your first thing is you're going to look in the delta column for at least anything that's the closest to a 90% delta. Remember, deltas go from 0 to 100. So we're looking at 90 delta options. So it looks like the 130 strikes got the delta that's closest to 90%. So we're going to key in on this strike right here. Number one, you got the strike, you got the delta, and now you look at the bid ask to see what you can do somewhere in the middle. Where can you buy this option in between the bid ask? The fair value is in between the bid and ask prices. So you want to get something right in the middle, which would be a roughly $75.35 per contract, $75.35 per contract. Okay. Now every number you see in this column has to be multiplied by 100 to give you the actual dollar amount that option costs. So $75.35 per contract is actually $7,535. If you were to buy 100 shares of Apple, it would cost you $19,725. You just multiply 197.25 by 100, that's $19,725. And right off the bat, this one's going to cost you $7,535. So right off the bat, you're getting a huge, huge reduction in your upfront capital that you have to lay out, your debit. Now, let me see how much of a difference that is. 19,725 minus 75.35. So you're looking at over a $12,000 reduction in the cost of your investment. Okay, that's huge. And you divide that by, let's see how much of a reduction that is. Divide the 12,000 by the 1,975. Okay, so you're getting almost a 62% reduction. Your cost is lowered by 62% versus buying 100 shares of stock. Okay, so we've gotten through the first step here. We saw how much this option costs, $75.35 for March 2026. Now we can look at the June. Now, the farther out you go in time, the more the options will cost, because the longer you give a stock to move around, the more the market makers are going to make you pay for that option. So let's again go through the list here, and we look for the option that's closest to a 90 delta, and again that would be the 130 calls. And in this case, the option would cost roughly $77.30. Okay, $77.30. So in this case, it's $7,730. It's about $200 more than what the March call would cost. So you have to decide for yourself, is it worth getting an extra 3 months of opportunity for Apple to move up in price? Is that those extra 3 months worth you paying an extra $200? That's something you just got to figure out. But you always want to compare it to what it would cost you to buy 100 shares of stock. All right. So in this case, you're still getting a huge discount, almost another $12,000 discount, but you're getting, 3 extra months. Now, I told you it's very important to figure out what the break-even price is. Let's key in on these Marches. Let's use March as the one that we're going to potentially buy. Now, this is not an actual recommendation. This is not a live trade. I just want to make sure everyone understands this. This is just for educational and informational purposes only. No live recommendation here. So let's just look at the 130 calls again. This is how you figure out what the break-even price is. Now, when you buy Apple at this price, that's your break-even. That's your cost basis. So anything above 197.25, you're making money. Anything below that, you're losing money. In this case, you have to take the strike price and add the actual cost of the call option. So in this case, 130 plus $75.35 is your break even is $205.35. Okay, you understand how we did that? We added 130 plus the cost of the option gives us $205.35. Now, that's about $8 higher than where Apple is trading right now. So when you buy this call option, the 130 call, your break even is $205.35. So you need Apple in the next 335 days. Let's go back to the chart here. Can Apple move back up to $205, which is roughly right around here? Okay, here's where it's closed. All it has to do is get up to about here in the next 335 days. Do you think Apple could move $8 from where it is now in the next 335 days? That's a long time. That's almost a year. I have to believe within the next year, Apple's going to be, well back above, maybe above all-time highs again. I mean, obviously no guarantees, but Apple moving up $8 in the next 335 days, I think that's a pretty good probability. Okay, so that, number one, you've figured out which strike to buy. Number two, you've got your break even, which is $205. So as long as Apple moves up above 205 in the next 335 days, you're making money. Okay, yes, if you bought the stock, you'd be making money as long as it goes above that price right there, right here, $197. But remember, you're saving over 62% of the capital that you have to lay out. And I'll show you how much the returns will be, how much you'll make on your returns versus the stock. And you'll be thinking, yep, you know what, I'm okay having to give up that $8 move in order to save myself 62%. Now, number one, if Apple, for whatever reason, crashes down to zero, everyone who owns Apple goes bankrupt on their shares. Here's how it's going to work. Anyone who holds 100 shares is going to lose the $19,000. Anyone holding the call options is going to lose $7,500. So right there, you're losing a lot less dollars. Now, you have your stop loss in place, so that's never going to come to fruition, unless it happens overnight one day and you have no chance of getting out. But anyway, having the call option, you're going to have a lot less money at risk. Okay. So let's look at what happens on the upside. Now, let's just say Apple moved up to $250. Okay, $250. What kind of returns are we going to see here from the stock, as if you held the stock, versus buying the options? Now, 250 minus 197 for the stock is $53. Okay, you have your 100 shares, you're going to make $5,300. Okay, $5,300 divided by your $19,700 investment, you're going to make about 27% return on that. Okay, does everyone understand that? If Apple goes up to 250 and you bought the shares at 197, you've made $53 or $5,300 on your 100 shares divided by your investment of $19,700. That's going to give you a return of 27%. Now let's see how much we would make on the call options. Let's pull this back up here. Okay, so you've spent $7,500 on the call options, $7,535, but let's round it down to $7,500. If Apple moves up to 250, here's how you figure out how much you've made. $250 minus the strike price of 130 leaves you with a value of 120. Now you subtract 75 from 120, your return is going to be $45 or $4,500. Okay, it's $45 per contract that you'll make, and your return will be $4,500. So you're making a little less actual dollars than the stock, but here's the return. Your 45 per contract return divided by the 75 that you spent is 60% return. 60% return. So your return is double than if you bought the stock instead. Okay, so number one, not only are you spending less money up front and your risk is cut down by 62%, but if Apple moves up the way you want it to, you're going to make double in returns, percentage returns, than if you just bought the stock. Okay, I want to make sure everyone understands how we figure out the cost of the return. So let's go back to our Word doc here. Let me get our Word doc here, and I'll type this out for you, okay? To find the return on the calls, let's take this off of bold here. Okay, to find the return on the call, take the strike price, subtract it from the current stock price. Watch me do this in real time. So that's the 250 current price of Apple at 250 minus the strike price, which is 130, equals 120. Okay. Now you've spent $75 for that call, and that will equal $45 per contract, which equals $4,500 gain. Not $5,500, $4,500 gain divided by the $7,500 that you spent on the call option equals 60% return. Okay, so that's how you do it. That's how you figure out your return on the call option if Apple moves up in the way you want it to in the long run. Okay, so very easy to understand. Knowing that buying deep in the money call options, 90% delta is going to get you 90% of the move. Now, the whole thing is that you want your option contract to move when the stock does. Now, we can go back to the option chain and you can say, you know what, I don't have the $7,500 to spend, which means you wouldn't have $19,000 to spend on Apple either. So what people end up doing, like I told you earlier, is that they would buy these really cheap, out of the money calls. And here's a call option with a 10% delta right here. The 290 calls would only cost roughly $210. That's $2.10 per contract, which is an actual $210. So they would focus on buying this 290 strike call, and your break even is $292.10. Strike plus the call, the option, $292.10. If Apple doesn't get up to $292 in the next 335 days, you're going to lose your $210. Okay. That's the thing here. The break even on the 130 calls is only $205. If you buy these cheapies, your break even is $292. Apple's at $197 right now. It has to go up almost $100 more in the next year in order to just break even on these things. So I understand it's a wallet thing, how much you can afford versus, the delta. Now, a lot of people will concentrate on the at the money strikes, which is the strike price that's closest to the current price of the stock. And those are usually, 50-ish delta. So in this case, if you bought the 200 calls, it's got a 58 delta. So those are going to cost you roughly, a little over $2,600. So again, cost you less, but the option is going to move 60% of whatever Apple does. So you have to decide how much money you're willing to spend versus how big of a delta you're going to get. Okay, it's completely up to you. But the way that I teach it is that we use the 90% delta. Now, yes, there are deltas that go up to 100. Now, the 90 strike, which is the lowest strike listed here, has a 97 delta. But that would cost you, roughly about $10,000. So for me, a 90% delta is good enough. It's going to give you 90% of the move of the stock. You're going to get a nice 60% discount on your upfront costs, and you're going to get at least double the returns if the stock moves the way that you want it to. All right, so that's how the deep in the money call works. Now, I told you that you can sell other calls against the call that you purchased. So let's go back and let's just say you bought the 130 call for March and it cost you $7,500. Now you can sell a call option against it. And what I said is very important, that you want to make sure the call strike that you choose is at least above the break even. And our break even's over $205. So you want to choose a strike price that's over $205. So let's look at the 210 call. Now this is for May. That expires in 27 days. Now it looks like they maybe added some strikes here. That's why there's no numbers for these things. So let's just say you sold the 210 call, which is above your current cost basis of $205. So you know if you sell this call option, you're at least going to have your shares called away from you above your break even. So the 210 calls, you'll get $365 for those, or $365 per contract, which would make this break even $213.65. So if you sold this call option and Apple rallied above $210, your shares would get called away from you at a price of $213.65. You bought it for $205 as your cost basis. Now you have to sell them for $213. So you're actually making money. So if you sold these and Apple didn't get above 210 by May, then you still have your long-term contract. And now you can go out to June after those May expires, and then you do the same thing. You look at the June calls, still above your break even. And so you collected $365 on that first go around. Now you can sell these 30 days later. It's probably going to be worth about $3 then too. So if you can chip away, you can sell $3 this month, $3 next month. That's $6 right there. So that knocks down your $7,500 investment. So maybe over the next X amount of months, if you keep selling these things and Apple doesn't move above these strike prices that you sold, you're cutting down the original debit that you paid to begin with. So you may be able to cut it down, a couple $1,000 depending on how Apple moves. All right. So that's how you sell the covered calls on those things. Let's see if there's anything left here. That's about it that we did. So there you go. There's your lesson on buying deep in the money call option. Now I want to show you something on our website here. Here's a special ebook that I wrote using this strategy, the deep in the money call option, on how to piggyback Warren Buffett. Now, Warren Buffett's one of the greatest investors of all time. Let's take a quick look at his chart here. Now, everything's been going down, but let's look at his Berkshire Hathaway Class B shares. Hello, everything's been going up. Warren Buffett's the man. So you can use this deep in the money call option strategy by tagging along or following along or piggybacking Warren Buffett. Okay, so you can go to our website right here. Smartoptionseller.com is our website. The Warren Buffett ebook right here. Here's the ebook that I wrote. So if you want to take a look, this is a strategy that the same strategy. I did it over a number of years. So you can, if you want to take a look, just click on the picture here and it'll take you to the page. It'll give you all the details about the ebook. Now, the other things that we do here at the Smart Option Seller is that we're big put option sellers. Completely different than what I was talking about today. The thing that we do the most is selling put options. If you know nothing about put options and know nothing about selling them, go to our website and you can get our free ebook. You hover over the More tab here and click on our free ebook. Okay, this is our ebook. All about put selling basics. It'll walk you through what selling put options are, why we love it so much, and why it's our bread and butter. And you scroll down here and you put your name and email address in here, and we'll send you an email back with a link to get the free ebook. Also, if you want a deeper dive into put selling, you can look at our 5-part video series, about 5 hours long, and it teach you the whole deep dive selling put options. Now we're also holding, last little plug here, we're also holding a put selling deep dive webinar. And that the webinars is where the video series is taken from. But if you want a live session with me, look at our put selling webinar. It's coming up on April 30th, not too long from now. So have a look. Here's the information and how you can sign up for it down here. All right. Lastly, services. We have a couple newsletters. We have our one-on-one coaching. We have our probability calculator. Take a look there. I hope this video has been helpful. Make these free videos for the trading community. And, I want to help everyone become a better option trader. All right. So that's all for me today. Leave me a comment. Give me a thumbs up. Leave me a like. down in the description. Below the description, I've got lots of links for books and videos and other websites that can help you as an option trader. All right. Oh, and lastly, I wanted to show you one other thing, a free website. Let me pull it up here. This is the optionseducation.org website. We look at the option calculator. I just want to show you how the deltas work with these options. Okay, I just want to show you how it works, so you understand that, knowing that if you buy a 90 delta option, you're assured that the option value is going to move 90% of what the stock does. So here we got Apple pulled up, and let's look at, we were looking at the 130 strike for next March of 2026. So let's pull that up. Where are we here? Right here, March 20th, 2026. We've got the 130 strike, and let's put in $197 for the stock price. Okay, so here's the value for the call, roughly $75 per contract. You can see right here, $74.98 per contract. That's roughly $7,500. Now, I just want to show you and you can see the delta here is 90% right here. All right. So let me just show you, if Apple moved up by $1 per share, I'm going to move this up to $198. This call option should go up about 90 cents. So it should take it to about $73.90. So let's move up Apple to $198. And the call option value is going to be now not $73.98, $75.90. Okay, we moved up Apple by $1. That call option went up by $1. Let's knock it back down just so you can see. And the value is $74.98. Take it up by $1. It's going to go up to 75 something. There you go. Okay, so the delta works like it should. Apple goes up by $1. That option price is going to go up about 90% of it. All right, that's it. I hope this has been helpful. Like I said, leave me a comment, leave me a thumbs up. Send me an email. I always answer emails as well. I know it's going a little bit longer today, but I really wanted to show you how to use this, bullish call option buying strategy versus buying 100 shares of stock. All right, that's all for me today. I'll see everyone in the next one. This is Lee Lowell signing off.